Hi guys, my name is Norbert Kiiza and I'm going to be speaking to you about trading psychology, the forms of trading psychology and why trading psychology is important when it comes to trading CFDs. So let's first get to understand what trading psychology is. So trading psychology essentially focuses on the emotional and the behavioral aspects of us human beings, our nature, and some of the things that tend to evolve around the way we act, the way we behave when it comes to trading. So there are various forms of trading psychology. Some of them include fear, greed, overconfidence, patience and discipline, and then regret and revenge trading. So let's first get to speak about fear. Fear is something that affects most of us. And of course, it's also something that also affects us when we trade. Fear, in this case, we are looking at opening up trades that we call premature trades, where you rush into positions when you're not supposed to be in those positions. And sometimes also you have a very good setup that you've seen happening over and over again in a market, but for some reason, you fear that if you take that trade, you're going to lose money. So sometimes when this happens, it affects our overall trading performance, and it's something that we have to make sure that we understand better when it comes to trading. When it comes to greed, we focus on overtrading. Overtrading is a desire to make profits, and sometimes it gets in our way because when you are greedy, you will end up going into the market even when you know you're not supposed to be going to the market. Take, for instance, time when you have a profit target for a day. Say maybe every day you're supposed to make maybe say $50. But after making the $50, you want to go and make even more than $50. And you end up now losing your $50 which you had already initially made. So that's one of the aspects that affects us. Now, greed can make traders hold on to losing positions as well. When you're in a position and you do not have a stop loss that you have put for that particular position, what will happen is that you have that mentality or you have that feeling that's in you that maybe your trade will somehow change into a winning trade. Now that's not good because most times in the market doesn't turn around. If a trade is losing, it will only get bigger and bigger, and that's usually not a good thing. Now let's look at overconfidence. Overconfidence essentially looks at excessive risk taking, whereby a trader will tend to open up very many trades, and they're not opening up only many trades, but they're opening up many trades with a lot of exposure to the market. Say for instance, you have maybe a trade on a Euro USD, and this trade is making you maybe make about $100 per pip. So every pip it moves, you're making or losing $100. So if it moves against you, say 10 by 10 pips, you're looking at maybe losing as much as $1,000. Now, the issue with that is that if it does not move in your direction, then you'll end up losing. Most times when traders do this, they end up going against, first of all, their trading plan, and then they also go against their trading strategy. Because most times you'll find that a trading strategy it's supposed to work in particular conditions. When the market does not favor it, then you're not supposed to be using that strategy. The other aspect is patience and discipline. And in this, we're looking at sticking to the plan, okay? And also being patient with your trades. Sometimes we are not patient with trades. When a trade is not working out, we want to close the trade, and we tend to get a mentality whereby we want to see money immediately. Now, if you're a person who is taking trades that can only work after a couple of days, you need to make sure you're patient. So the moment you're impatient, the moment you micro-control your positions and not let the market do its thing, it can actually affect your trading performance. Now, waiting for the right trading opportunities is very, very important, but we find most times we are forcing trades. When a setup is not there, we are trading. When the market is not telling us anything, we are trading. Now, the other one is regret and revenge trading. Picture this. Let's say, for instance, you're trading and maybe the market takes some money of yours. Let's say, for instance, you are doing NFP trading and it was a bad NFP day and the market took your money. And now what you do is that you want to get back and say, I need to get my money back from the market. So you deposit money, then you trade again, and you're not focusing on what is before you, like what is the market telling you, whether it's a buy or a sell. You're not maybe looking at aspects such as the time you're trading, but for you it's merely wanting to see blues on your screen, because we know that when you're in profit, definitely you'll see blues. Now, the issue with that is when you make a loss, okay, from revenge trading. It can affect you emotionally. It can also affect your general well-being, because you'll be feeling bad that happened, and that's usually not a good thing. So when we look at revenge trading, it's merely trying to recover losses quickly, and this can result into taking irrational risks, okay? Say you have a loss of $100. To get back at $100, you're going to be forced to deposit more money to trade and get back that money, but that's not good, because the moment you don't have a strategy, the moment you don't have a trading plan, the moment you're not doing analysis, you're purely gambling, and that is not a good trait when it comes to trading. Now, when it comes to some of the things we can do to protect ourselves from allowing our emotions take charge when we are trading, first thing is emotional control. When it comes to emotional control, we are saying you need to reduce emotional trading. Doing technical analysis and fundamental analysis is important, because it means that whatever decision you're taking in a market, you're taking it from a technical standpoint or from a fundamental standpoint. And we call that rational decision making when it comes to trading. Now, the other one is managing stress. When you're trading, you have to make sure that you have absolutely no distractions at all, and you shouldn't be trading to accomplish a particular immediate need, okay? Trading is entirely based on a market. What you can control is what you can risk, but the result of what you're risking, the conditions about the result, all that is beyond you. Now, the other part is risk management. When it comes to risk management, we are saying you need to prevent over trading. You shouldn't trade too much. You should only trade when the opportunity is available to you, and whenever your strategy is telling you to enter the market. Now, the other important aspect is having a delicate risk-reward balance. So when we talk about risk-reward, we are saying that for every trade you take, you need to risk a certain amount of money, and that money should be within it should be a comfortable amount for you. So this varies according to some different people. Some people will risk $10 per trade in hope that they make maybe $50. Other people can't even risk even more, but you have to make sure that whatever you're risking is not going to affect your trading balance on your FXPesa account, and it should also allow you to be able to continue with your trading without it being affected in any way. Now, maintaining a risk-reward balance encourages adherence to risk management strategies, and it also does something that's very important, which is preserving your capital, okay? So your account will never get blown, especially if you have a risk-reward that you're using in your trading. Now, the other one is adaptability, okay? Handling market changes. The market, just like I've alluded to, is structured in a way that you shouldn't be trading all the time. You have to focus only when the market has an opportunity. And when that opportunity is there, that's when you trade. When it's not there, you wait for another day to trade. Just a fact that you guys need to know is the market is not open only once a week. The market is open 5 times a week. So which means Monday through Friday, you cannot fail to get a day to trade. If you didn't trade on Monday, you'll always trade on Tuesday. If you didn't trade on Tuesday, there will always be Wednesday, Thursday, or Friday. Now, reducing impact of losses. Adaptability helps in quickly recovering from losses and not letting them affect your future trades. If you have risk-reward strategy whereby you're risking $10 to make $50, you will ensure that, say, maybe for 2, 3, 4 days, you've been losing $10. That's maybe a loss of $40. It means that your capital is going to be down by a certain amount of money. Okay, now the important thing with that is if you have a period where you're in some kind of a drawdown and you've been making a few losses, when your trades now start to make money, you're going to recoup your losses much easily. But if you have a very huge loss, it's normally harder for you to recoup the loss because you're already in such a big drawdown. And sometimes it even gets worse whereby the account is gone. Now, we shouldn't get to that point because risk-reward is something that we speak a lot about, and you have to make sure that you use it with your trading. Now, the final thing is decision-making. Judgment is something that's important in a market. Clear thinking leads to better evaluation of trading opportunities. Your approach to the market should be one that is clear of any kind of... You shouldn't have a preconceived thought of what the market is doing. Sometimes we tend to look more at the money and focus less on what is happening on the charts. but the charts will always tell us what is happening. If the market is selling aggressively and I'm a scalper, I'm not going to be buying. Either I will sell or maybe I will just leave what is happening. So when you find yourself doing opposite to what the market is doing, then you just know that you're not having a clear approach to the market, and you have to make sure that you avoid that. Now, every single person has a variety, has something in particular that affects them. You'll find, for instance, that you're an impatient trader, or maybe you find yourself sometimes deviating from your trading plan. Sometimes you find yourself trading even when you're not supposed to be trading. It's important you do a personal evaluation of yourself and find out what things affect you, and then you can seek help in those particular things. Like, for instance, if you find like you're greedy, you need to find a way of limiting your trading. If maybe, say for instance, you have fear, you need to look at the trading strategy you're using and make one that at least aligns with giving you that confidence. So that is what trading psychology is about, and I'm hoping that after watching this video, you're going to make a personal evaluation of yourself and identify the pitfalls that are affecting you when it comes to trading psychology, and look for some of the ways that you can improve on your trading. Watch through this video again if you feel maybe there are certain areas you might want to check and improve, and I hope that this will help you to improve your trading. Thank you. Watch this next video if you want to learn more about trading.